And right now we're looking at what can artificial intelligence really do for us.
But what do you see, if you have your crystal ball in front of you right now, what do you see as the drivers for the growth in innovation over the next decade? Is it technology, healthcare, sustainable energy? We talked to a guy the other day who's got a fabulous product that's plastic gloves and saran wrap and things made from cane sugar waste. Welcome to today's episode of Resilient Alpha, where we're going to talk about accessing private equity and what's right for your family. I'm thrilled to have with me Gary Post, who's a very seasoned expert in the space of private markets, and whose experience extends from working with high net worth families to managing sophisticated portfolios through his own fund, K Capital Management. Gary started his career, I believe, at McKinsey. He guided family-controlled European businesses on their growth plans and acquisitions, and today has his own suite of funds, as we mentioned. We're going to unpack private equity and talk about your views, what families should be thinking about investing. Are we doing it here in the U.S. or other parts of the world, and why? So stay tuned for a really interesting conversation, followed by a rapid-fire round of lightning questions. Gary, can you tell me, welcome, first of all.
Thank you for having me.
Lovely to have you with us. Tell us briefly about your background and how you came to founding K Investments.
It all started probably my first day at work at McKinsey, and the training I got there was preparation for everything else I've done later. I'm very grateful for that experience and other experience I've had during my career. I've gotten to be not only with McKinsey and consulting, with leading investment banks, Kidder, Peabody, and Drexel. I've been an interim CEO at companies and finally private investor. In the context of being a private investor, three families came to me 11 years ago and said, "We want you to manage private equity for us." And I said, "Well, I don't have a fund. I don't plan a fund, and I don't have outside money." And they said, "No, it'll be great. You'll have more money." So I asked them a key question, which is, "Well, what do you want to do?" And they said, "We don't know, but we know you know." And so that was the catch that said, and like 6 months later, we were the K Fund LP.
Where did K Fund come from?
K stands for Kilimanjaro, and it's a mountain I hiked in another eon. And when we were looking for a name,
summit?
We got to the summit, the two of us, and the other person went with me is now also an investor in the fund. So it was the start of the K Fund. And what I observed when we were looking for a name for the company is to get to the top of Kilimanjaro, you have to be prepared, patient, and persistent. You have to have the right clothing, the right anti-altitude sickness, and you're going through multi-zones. You're going through subtropics up to frozen tundra, up to the Arctic. And we're a multi-stage investor, so it all kind of made sense. But I didn't call it Kilimanjaro Capital because I didn't think—
That was probably already taken.
No, it was clean. It was clean. I was only battling the University of Kentucky for the name, but no, it was all clean. But I didn't want to have people stumble over how to spell it. I also called this a fund, so said we have money. So I didn't want to be partners of capital, and that's how it all got started.
So the focus is private equity. And when you think about private equity, how do you see it fitting into the portfolios for families over the next decade? There's a lot of talk in the marketplace today, too much private equity, money's not getting returned as quickly as it was, it's oversaturated. How do you think about it? And how should and why should private equity be part of a family's portfolio?
Well, first of all, private equity is not just buyouts and big names and, Ares and Blackstone and such. No, it's a continuum from venture capital ranging from your neighbor's food truck going up to the largest going private transactions. We're investing in the middle, which we call growth capital. It usually is non-leveraged, and it's where the real fast growth happens today. And then up above that is large-scale buyouts, middle market buyouts. That's a different business than what we do with different investing objectives.
So Gary, tell me, what's your sweet spot in terms of private equity and what you're looking at? Like if I'm calling you with a deal, what are the bullet points that are going to get you to call me back?
It's typically a company that has defined a different way of doing things, typically with information or information related. We like to see who the investors are in it. Typically, they're premier venture firms and private families that we know of. And these companies are poised for rapid growth by doing things differently. So we looked at that in pharmaceuticals. We looked at that was with Blink Health. We looked at it in SpaceX, and we were involved in SpaceX when there were like practically no satellites up. But we had a tour with the CFO. We brought 6 families with us, and we got the story that what they were going to do is build a telecommunications company. And we said, that's great, we're in. And there were like no satellites up. Now there's thousands of satellites up. So that's a typical example of we can see what's happening, very credible management. We can believe they can do it, and with referenceable investors and customers.
So you're trying to be forward-looking, seeing where the puck is going, as that famous hockey player once said.
That's exactly right. And that's why we're looking at information-related companies in different ways, because they can scale really fast, and the science is understandable to us.
And it sounds like that doesn't limit you to a specific space or industry. And
Not at all.
I don't mean space in terms of SpaceX space, but I mean you're agnostic as to what the business is or what sector it's focused on. You just want something that's got a forward future.
They have a plan to do things differently. And that's the foundation. Usually software is part of it and systems are part of it, but we're not software. We're solutions. We're innovation backers. And once we see enough there, like Blink Health, redefine the supply chain for pharmaceutical distribution, we love the management. We had good investors on board with us, and we choked on the valuation. Yes, we did. We said, no, the idea is so big that valuation is justified. And so we were in and wrote the check, and we were followed on in several rounds after that as well.
And are you just investors, or do you become more hands-on, getting involved with these companies and the managements in terms of helping them grow?
The best way we can help companies is with introductions to other resources, other investors, customers. We're not, to be very honest, we're not operational people. And typically the kinds of people that we invest with don't really need somebody else coming in and nitpicking their insurance agent or where they're relocating to. Is we'd rather leave board seats to people that are more qualified than we are. And that's the best thing we can do for companies.
So going back to family offices, and as they think about investing in private equity, how should family offices be thinking about the illiquidity of what you do with their need for flexibility in the overall investment portfolios they're creating for their families moving forward?
That's step one. Step one is planning their liquidity for the next 10 to 20 years. And one of the biggest mistakes you can is to invest a lot and not be aware of all the capital calls that come in down the pipeline, and you get caught in an illiquidity crunch at your family because to a degree you're over allocated. So plan out next 10 to 15 years, take that number and then double, and then you probably have a good sense of what you can do in private equity.
And following on to that, what are the ranges of the kinds of products that families can look for when they want to access the private equity space?
Well, there's a broad range of things, from the simple, easy to do, lower returns to the highly complex with an enormous level of expertise required. So we start on the simple side. We have things called interval funds. They're also called evergreen funds. And they're actually mutual funds. They're organized like mutual funds under the 1940s Act. And people can invest in well-known institutions, very, very good firms, create a portfolio of other managers for them. Often in the evergreen funds, there's a fair amount of private credit in there. And so it's more of a private markets fund, but that's not all bad. The reason they have that in there is to manage liquidity, because they're required to have the capability of making redemptions every year. You can move on from there to fund of funds. Fund of funds also offered by very well-known, very capable institutions, and they'll take somewhere between 6 and 12 other funds. They could be buyout funds, venture funds. They could be some kind of potpourri of funds, and you invest in that fund of funds, and then you sit back. So those are the two simplest. And so are we good there? No, we're not good there, because the largest institutions, the most astute and capable families want higher rates of return. And they want more pure plays. They don't want to really be involved in the debt side. They'll do that separately. So we have closed-end funds where you invest in typically capital is drawn down over a few years. You have, after you've picked the fund and the strategy that they offer, you're stuck right there, and you're going to be with them for at least 10 years. And you have no say on what the strategy is going to be, when they're going to invest, what they're going to invest in, and how much they're going to invest in each type of firm. And that's a popular place for families. But as you might expect, you need some level of ability to do that.
And following on to that point of the level of ability, is there has been a trend in the family office space, seeing more family offices saying, oh, I'm not doing funds, I'm doing direct deals, I'm going to do it myself. People show me things all the time, and I can do this. How should family offices be thinking about their actual ability to do this themselves versus outsourcing it to guys like you?
Yeah, there's not many families that I would advise they can do it themselves. And it's usually $500 million and up that can afford to have their own staffs, source their own deals. And if you're sitting in London or Paris, when you didn't go to the Little League game in Palo Alto last night, you may not get into the best of transactions. That's why people that are boots on the ground have a natural advantage. Even so, there are many well-known families, and we know that those are. It's a good idea. But remember, one thing is, if you're in a closed-end fund, when you're dividing up the proceeds and hopefully profits, investors, limited partners get all their money back. All the money for fees, all the money they invested, all their money back. And if you're running an in-house shop, that money is spent. You hire people and you owe them some carry. So that is the upside is immense flexibility, ability to influence companies that you invest in. That's a real healthy upside. And you may get into investments because people like family offices, and it's somewhat prestige to have that family office or that family office involved rather than venture firms. And we actually get into a lot of things because we're perceived to be a family office investor.
And I think there's also the perception on companies' part that family offices tend to be stickier money. I mean, venture funds can be sticky money because they're in and they have their money for 10 years, but they're more dynamic because they're more professional. I think there's a view from a lot of companies that having family office money is a little easier for them.
Well, there's a perception that they're more patient and they can provide additional expertise. They're not lumped in with venture firms that have a set schedule they have to get out. So a lot of people like that. In reality, I'm not sure how much of that really exists. I think in the buyout sector, people can be very, very patient if they're a family investor.
And where do families get tripped up? What are the mistakes they can make?
Yeah, there's two principal. There's a lot. There's a lot of mistakes, but there's two glaring situations that you don't want to do. The first one we talked a little bit about is poorly planning their liquidity needs. That's a shame. And sometimes it's not entirely under their control. Over a 10 plus years period, things may change. Their base business may change and such. So it happens, but for the most part, you can plan ahead for liquidity needs. The other, which we see a lot, is kind of a willy-nilly, self approach, and your neighbor brings you a new restaurant deal or a gym or something, and you end up with a hodgepodge of relatively early stage investments.
And be careful what you hear at the country club.
Well, yeah, I mean, that's precisely right. It's not saying you can't be in an early stage company, but you need to be in 20 early stage companies to make sense. No problem. If you know what you're doing and you're going to do 20 early stage investments, you're probably going to do okay if you have the expertise for that.
And what about co-invest? So now I'm a family. I've decided I'm going to build a portfolio of managers, guys like you that may do things a little bit differently from each other, my own fund of funds, as it were. And now I have the opportunity to co-invest. Is that a smart idea for families?
I think it's a great deal for families, particularly if they've invested in a fund, like we've offered co-investment in SpaceX and Epic Games, and more recently CoreWeave. And so the fund's already in it. So you as an LP have the confidence that we've scrubbed down the situation and we're in it. And so you can get information we're going to provide to you and say, yeah, I really like this CoreWeave, and I'm going to kind of double down to a degree by co-investing. And co-investing typically has lower fees and carry. So that's another benefit to LPs. So under that basis, but do beware of brokers that put together some packaging of companies that they don't have any information on. We can only invest when we have information about the company, and our auditors can see that, yeah, we value the company based on real information. So that excludes us from some types of investments. But yes, and be careful.
Well, and I was going to say, be careful because you don't want to end up over concentrated in certain kinds of things.
That's correct.
Particularly if you're seeing co-invests from different managers that might have similar mandates.
Yeah, we're typically offering about 2 a year. And because we're by nature diversified in terms of industries and solutions and objectives, like Blink Health is not the same as SpaceX. And so you get a chance to be diversified within a fund, depending on the objectives. And we started day one with a strategy that would provide some diversification for LPs.
And does the co-invest opportunity come mostly from, and it may be both, you decide that your fund or your amalgam of separately managed accounts have enough? So now you're being offered more in a follow-on round and you don't want to take it into the fund? Or is it that you're being offered extra, and
well, it's both
if
of
you
those.
offer, so I guess my question is, if you're offering at the co-invest, does that mean you've already put some of the co-invest in the fund, or do you do both?
Well, first of all, we've never offered co-invest that the fund didn't already invest in or is investing at the same time. And that's a good faith. We're not selling anything. We're offering really co-investment. So it's sometimes, one time we had so much demand, we got calls, hey, we want to be in SpaceX. And the funds had basically finished investing in SpaceX. We put a little bit of money in good faith, but we had an enormous amount of LPs. Did we feel good about it? Yes, we felt good about having those people involved, but it's more anticipating a 2x return over 3-4 years rather than, we have 12 or 14, but we were in, like I say, when there was nothing doing on satellites up there, you couldn't find the satellite, even if you knew how to look for one.
And do you offer co-invest to people outside of your fund investors, or you really only have access to it if they're already invested with you?
Well, we make sure our LPs are taken care of first. For the most part, we have been able to offer what I call our community. And our community are people that we know well personally. And it's they may have done some favors or special things for us. So we invite them in. And we've had a mix. But in every case, we've taken care of our own LPs first.
As it should be. And so I know you do both commingled funds effectively and separately managed accounts in your business. How do you think about that? I mean, is there a best way for a family to do it? Should I want a separately managed account or go into a commingled fund, or are there reasons in different situations to do one or the other?
For many families, a separate managed account, and I also include wealth managers. They may aggregate some families, maybe 5 to 10 families to be part of it. And where this fits in, it's a little bit of a hybrid on the closed-end fund because it yields the family or the wealth manager way more flexibility and control over the situation if they want it. Now, in a lot of cases, we've done 11 years of separately managed accounts, and people have said, well, we trust you. Yes, our investment committee approves it. So we've had at least 2 out of 4 members of the investment committee have come from the LPs. So they're really controlling things, but we won their trust over time. So the starts with jointly developing strategy. What do you want to do? Is back actually similar to what I was doing at McKinsey, for that matter. What do you want to do? What do you want to accomplish?
So it's customizable.
It's customizable strategy. And that's what we did 11 years ago to get started.
I don't want oil, or I don't want tobacco, or I don't want, I can.
Yeah, we don't do tobacco, firearms, and stuff like that. But it could be more specific about that. And we work out the strategy. Then we present ideas to them that have crossed through, approved by our internal investment committee that says, yeah, this is something that we would like to present. Then they can say yes or no. They can also say, we want in for $1 million in CoreWeave and $10 million in SpaceX, and whatever they want to do, they have the flexibility to do that. Or we've got one of our family members that's ill, or we're selling a plant in Italy and we can't invest for 3 months. We're just too busy to do that. All of that's possible on a managed account. And the question is, well, how much expertise do you need to have that to be able to do that? And it's enough, but it's not a huge amount. And that expertise can come from a family member, or it could be a wealth manager. And wealth managers, though, in very large firms don't have access to sub $500 million funds. So if you're looking to get in private equity and your wealth managers is a huge entity, and it's not that they don't like the sub funds, they're just not big enough for their distribution. So you may be ending up with larger scale buyout funds that, yes, they're private equity, but they don't reflect the true growth of America. And that's what we want to be a part of history. We're proud to say that, hey, we backed this company when they didn't have anything, but they had an entrepreneur in a system and they were doing great.
And so you mentioned the growth of America. You are, as a firm, focused on the U.S., I think, pretty much. And what are your thoughts around that?
Yeah, we are focused on companies that are domiciled in the U.S. We'd prefer not to take some of the risk of being in foreign countries. One, unless you have boots on the ground, in France, Italy, wherever that company is. Well, you're remote. Maybe there's language difficulties and such. There's currency risk, and there's more geopolitical risk because you don't know the laws in France and what a company can do or hire or fire people. So we're focusing on companies that are domiciled in the United States, but they could be doing business elsewhere.
But you're really focused on innovation. So would you say that we in the U.S. are better at innovation, or involved in more exciting innovation today?
Yes. And I'm backed up by Europeans that have told me that as well. And so we don't feel we need to go to other countries. Would we at some point in time? Will be based upon some solid partnership with somebody who's there, like another fund. But right now, we don't think the risk is worth the return. We think there are tremendous opportunities just in the United States.
So never say never.
That's correct.
When families are thinking about the kind of returns they should achieve from this kind of investing, how should they be thinking about that? Especially, specifically to your strategy, because I know that's where your expertise is and where you focus your time.
Yeah, I think and if you go across the spectrum, no matter how you get into private equity, what instruments you use, the first measurement is you must be earning more than the market, S&P 500, NASDAQ, index, whatever you want to call the market, that you've got to be earning more money than that. That's not that complicated to figure out. Then the next step beyond that is, well, okay, what level of risk are you taking to get there? And let's say you're pursuing a early stage strategy and you've only invested in 8 companies. And let's say you have, you're earning 30% over the S&P 500. Well, okay, but you're not doing very well at that. And you've taken more risk.
Exposed to 8 companies.
Yeah, you're only exposed to 8 companies and you're earning 30% over the S&P 500 or any other index you want to choose. And that's not good enough. If you are earning 40% over the S&P with a large scale buyout fund, which is more correlated to the public markets, then yeah, okay. So
that's a home run. I don't think that really necessarily exists, but
yeah. But that with that level of risk, you've done well. So be happy. Now there's all sorts of other metrics.
So everything's relative.
Yeah, everything is relative, and there's all sorts of other measurements. It's probably too complex to get into. Professionals look at them all the time, like vintage years comparison. But the main comparison is you need to be rewarded for that illiquidity from the private markets. And you need to be rewarded with some reference to the level of risk you're taking.
So we try to be very forward-looking here, and you clearly are forward-looking from your earlier statements in terms of, looking for companies that are truly innovators and are going to be where the puck is going. But what do you see, if you have your crystal ball in front of you right now, what do you see as the drivers for the growth in innovation over the next decade? Is it technology, healthcare, sustainable energy? Non-plastic plastic. We talked to a guy the other day who's got a fabulous product that's plastic gloves and saran wrap and things made from cane sugar waste, which dissolves in hot water. I mean, how are you thinking about that?
First of all, I'll give you what we're thinking of, and then I'll give you a broader scope. And one of the elements, something we're not thinking about at all. We have been interested since day one in companies that use information to do things better. And to a fair degree, we've been going, we have been where the puck was going. And right now we're looking at what can artificial intelligence really do for us. There'll be some huge winners in that space. It's very difficult to figure out what's artificial intelligence and what's an algorithm. What did humans actually come up with? And they have 320 simultaneous equations. Well, it all goes back to human intelligence and not artificial intelligence. So artificial intelligence, companies that use information to do things better, provide information to do things better, like a satellite company providing information for agriculture business. Now that's a new twist. We are looking at that when those kinds of things. It's information to do things better. On the other hand, we're not looking at launch companies which do not have the same scalability or the same light asset focus that we have. Now, if I may give you an area that we aren't going to do anything about, but I would urge people to look at it, is I thought that this century is to a degree the age of biology, and the age of information, which you can say goes back 1990 or the start of the internet or wherever you want to go back, is a driver of incredible things in the healthcare sector. Whereas we might be happy with a payment system, processing companies that can do it 10 times faster, they may be in the age of biology doing things that revolutionize what we do with our bodies and how they change over time.
And why are you not getting involved there?
We just don't have the expertise for doing it. I think it's also a business that you need a lot of money and a lot of expertise and a lot of luck to be able to do all of those at once. And we don't feel we're serving the objectives of our families by being in there, but I call mention of it because that's something that people, families with the expertise and the capital, should look at.
So I think what you're saying there is it's really interesting. if you're going to invest there, make sure you've got really strong experts that, have enough money to be involved in the space the way they need to.
Yeah, and a lot of bets in that industry, I think they call it shots on goal.
Fair enough. They do tend to be binary.
Yeah, we don't like binary.
So macroeconomics affect all sorts of investing, right? And private equity tends to a certain extent be somewhat shielded, and maybe it goes back to vintage years, depending on what goes back, what happens in the macroeconomy during those vintage years. But how should families be thinking about the macroeconomic environment alongside their investing in private equity? And interest rates, political risks, as you brought up, as a reason to stay local, as it were?
Mm-hmm. Well, I'll tell you, first of all, where we've come out on that is we're investing in companies that no matter what the general macroeconomic conditions are, let's say in the United States, possibly the world, they're providing enormous value and they're going to succeed in any macroeconomic environment. So if Starlink can provide internet service to half of the globe that didn't have it, are people going to stop paying for it? If they come out with telephone service, are people going to not pay for it? If you can lower the cost of drugs like Blank Health by 50, 60%, are you going to stop doing that? No. So those are the kind of companies we're looking at. Now, if you get into more buyout strategies, then you have more sourcing issues, geopolitical issues come up, and maybe if your defense dries up, then, or you're manufacturing for a certain kind of product, that those are more risky and more geared to macroeconomic climate. We're also not investing in companies that borrow money, so we're not as sensitive to interest rate cycles.
I think this is the last question before we go on. You recently announced a joint venture with a Silicon Valley firm. Maybe you talk about that for a moment and why a fund as successful and established as yours would do that.
Well, we think sourcing is really important, and we think scale to be the very best at sourcing. And this, we're going to be announcing our relationship next few days. And what this other firm brings to us is a lot of expertise. They have subject matter experts. They have over 100 people. And what they're bringing to us is that expertise and the ability to source transactions with us. So we be sure that we're offering different strategies, which they can help us do, that we can provide the best for our families, particularly in the managed account format. And that's why we've done it.
So do you want to give a spoiler, because you're announcing in the next couple of days and we won't be out in the next couple of days?
I will.
It should be announced. I mean, it'll be announced by the time we come out.
I'd love to do that. It's Pegasus Technology Ventures. And let's go back to first day, work day at McKinsey. And one of my friends there is Bill Reichert. And he and I became friends many, many moons ago. And we had a conversation about a year ago. What can we optimize for family investors going into the future? And we came up with this relationship, which we're very excited about it. It brings enormous additional strengths to how we can serve people.
And I think that speaks to how important relationships are in this business, and relationships that endure, that you've been able to come up and build this joint venture. So congratulations. And I'm sure we're looking forward to hearing more. Gary, it's been great to have you. We're going to take a short break before we go into the lightning round.
Okay.
Thanks so much.
Thank you.
So, Gary, we've had a great conversation so far. I'd appreciate it so much. But now it's time for the lightning round.
Oh, great.
Quick questions, quick answers. You ready?
Ready.
What's the most critical resource for a family investing in private capital and private equity?
Proper perspective of what they're trying to achieve and what's available for them to achieve it.
What's the biggest misconception families have about investing in private equity?
They think they can invest in one fund and they're in private equity, and they may end up with a large-scale buyout fund that a large wealth manager gives them.
In-house or outsourced?
Outsource, not 100%, but 90%. For most families, it's outsourced.
What's an emerging private equity strategy you think families should be exploring?
Well, we like the managed account program because it gives people the same access they want. They really want access to great investment. We do that. But they also don't want to be isolated and remote from the process. So we give them a chance to yes or no on a deal, vary the amount that they can invest, and have a confidence that they're involved in the process.
What's the biggest red flag an investor should be looking for when diligencing a private equity manager?
It's looking for people whose experience as managers matches up to the fund they're trying to run. So we see a lot of situations where people that came out of investment banking or maybe a private equity shop, and they're suddenly going to be artificial intelligence gurus. And so that's probably a red flag. You probably you need some real gurus. And that situation actually just came up.
Okay, and you're a guru, some would say. What advice would you give to a young person that wants to get into the private equity business today? What piece of advice would you give them in terms of how they should be targeting or their career trajectory?
Get in early at the lowest level, analyst level, and learn the business, because it's experience and seeing a lot of things that will enable you when you're a partner to make the best judgments.
Make a bold prediction in private equity for us.
I think the secondary market is going to continue to explode, whereas there were maybe 5-7 years ago, there were maybe 3, 4, 5 names you could easily sell. Now I think there's over 100, and the infrastructure for
not being a primary investor at a fund, but buying somebody's former investment in a fund.
It could be buying from an employee, from an officer, from another fund. A lot of people would like to sell, including insiders. And that's we're going to do some fishing there shortly.
And just a last question, I'm curious. Tend to ask a lot of people this. If you weren't running KFunds, if somebody said, you know what, Gary, you can do anything else, but you can't do this anymore, what would you do?
Well, my dream job, if you will, is I'd like to write a weekly op-ed column in the Wall Street Journal. And my objective would be to be non-political and offer clarity on really complicated issues. So if somebody that picked up the paper and read it and they walked away and said, I got benefit out of that 5 minutes to read Gary's article. And I'd also like to play more golf on a global basis with my family, friends, and business cronies, and have a bunch of fun and trade ideas. And,
well, the good news is you can probably write that op-ed from anywhere in the world.
Yes, I can.
Well, Gary, it has been a pleasure to have you with us today. Thank you so much for spending your time at Resilient Alpha, and we hope you enjoyed the show.
Hey, thank you very much.